This episode is brought to you by TWO12, the official sponsor of the MJ Bulls Cannabis Investor Series. I've been an entrepreneur pretty much my whole life, so I know how difficult it is to raise money. But for me, the most frustrating aspect of raising money is how many things are out of my control. However, there is one thing that you can control, and that's building and maintaining a clean cap table. Listen, I've worked with investors for over 25 years. They do not have a lot of time, so they're looking for reasons to say no. If your cap table isn't on point, be prepared for them to move on to the next deal. And that's where TWO12 can help. Their incredibly easy to use yet powerful cap table management and financial modeling platforms are designed specifically for founders and angel investors. For just $20 a month, founders can be confident that their cap table is clean, and investors can see how much they stand to make if your startup rocket ships. But maybe my favorite feature is the ability to see how much you'll get diluted if you take that check. After all, what's the point of building a successful company you don't own? If you're a founder or an investor, you owe it to yourself to check out TWO12's website at TWO12.co. That's TWO12.co. And get this, they're giving MJ Bulls listeners an additional 25% off their first year's membership with discount code BULL. Dilution is real, it's complex, and it's expensive. For just $20 a month, well, $15 if you use the discount code, you can sleep easy at night and be ready when your next investor says yes. Don't take a chance. Go to TWO12.co, use code BULL, and never worry about your cap table again.
Forefront to prove that they can not only drive EBITDA through their businesses, because that's less meaningful, it's actually cash flow through the businesses after 280E. Once you've seen that and people have gotten to a point where they can supplement external capital with organic growth, with organic capital coming through the business, I think you've been able to pull in some really strong operators from outside the industry as well. And it's that marriage of talent, which is really creating a new pool of earlier stage companies and mid-stage companies right now are far more grounded, far less pie in the sky than years past.
From the PodConX studios, high in the Rockies at the beautiful Beaver Creek Resort, it's the Raising Cannabis Capital Show.
Today on MJ Bulls, we are continuing this year's TWO12 Cannabis Investor Series with Nico-Richardson, the Managing Director at AFI Capital Partners. Nico, welcome to the show.
It's great to be here. Thank you for having me, Dan.
Well, I'm glad you could join us today. Most cannabis investors have a specific sector or a specific stage that they like to invest in. For instance, some like plant touching and some like non-plant touching, and some like early stage and some like to invest in later stage companies. Do you have a specific cannabis sector and a specific deal stage that you like to invest in?
We've put enough guardrails around ourselves in the sense that we don't really operate in other industries. We really do just focus on cannabis as our expertise. And because of that, we've really played along the life cycle of multiple companies and also in the ancillary and plant touching spaces. When we first started AFI Capital Partners in 2018 in our first fund, we had a core focus in ancillary companies. And then we utilized a sidecar alongside our fund to invest in some plant touching opportunities for our investors. Over time, because we have a pretty broad approach to cannabis, we've been able to flex into some plant touching opportunities for our second fund, really because we see great opportunity in how the market's setting up right now.
How about the stages? Do you prefer early stage or again, does it just depend?
Yeah, on the ancillary side, we really do go primarily early stage. Our first fund was much more set up as a venture fund. In plant touching, we are earlier stage, we'll put it that way. So we tend to fit pretty well within the growth equity buckets. We're not doing Series D, Series E for late stage private companies going into public companies. We don't do any sort of secondary and public companies for the most part, unless there's a very unique circumstance. But typically, we're not playing in that sphere. We're looking at Series C, Series A, bleeding into B on plant touching opportunities as well.
Okay. Yeah, you mentioned the sidecar. Maybe you can explain that a little bit further, because I think you're one of the few companies that actually employ that tool.
We've used it differently for different periods and what we're investing in. So really with our first fund, we used it as an opportunity for our investors to get looks at plant touching opportunities. Our first fund was really ancillary only, yet we were still doing some individual investments in plant touching opportunities. And we found over time that we had a pretty strong demand from our investor base to get optionality into those opportunities. Mm-hmm. And so we created a serial LLC alongside of our fund where people could invest through that in single one-off opportunities. We've continued with that strategy in our second fund. So our second fund is all plant touching opportunities. It's all really single state licensed private companies. And what we do with Sidecar in this opportunity now is we allow our investors to maximize their optionality and to lean into investments they really like within the portfolio. And really, we find that family offices that invest with us tend to exercise that optionality in the Sidecar quite a bit, to the point where sometimes they'll leverage more capital into the sidecar than they do into the fund itself. Yeah. And what it allows G and I to do, and what it allows AFI to do, is for a relatively smaller size fund, we can punch above our weight and end up leading much larger rounds with much larger check sizes. So, our last deal that we did was Texas Original out of Texas. The ratio of fund to sidecar was actually more like 1-3 than 1-1. It was because we have great partnerships with our investors whereby we can structure these deals with them in mind, and they can lean into those a little bit harder.
I mean, that's interesting that they have that option to add on. You mentioned that you do a lot of single state, single license deals. Do you do any deals prior to the license being issued, like for people that are applying for a license, or are all the deals once the license has been issued?
We view that a little more like buying a lottery ticket. That's not quite what we do, right? Really what we do is coming in the early stages and help bring expertise that we've seen from around both our portfolio of ancillary businesses, but also our plant touching ones, and help new licensed businesses sort of avoid the early pitfalls of new markets. Mm-hmm. And so the licensing opportunity, if you hit it, it's great. People will have phenomenal returns on those, but we view it a little bit more like a lottery ticket. Your probability of failure is quite high. And we like to avoid zeros. We're squarely in that kind of 3 to 5 and up range is where we want to be. And we'll avoid taking unnecessary risks to do so.
Yeah, I just was curious because I'm sure there's a lot of demand for that. That's for sure.
Where we'd like to be is sort of this last investment in Texas. They had been licensed since 2017. We came in and gave them growth equity funding in 2021. For them, it was still a very nascent period because the Texas market hadn't really opened up yet. Now it's really blossoming and going quite quickly. But there was a lot of know-how that we could bring to the table and help them along. And just they had a great operation beforehand. They're going to have a great operation afterwards, with or without our capital. But we feel like we gave them a little bit of a head start within the market. It makes sense. There's no doubt about it. You mentioned that you do some deals that are with bigger check size, but I also noticed that you do a lot of co-investing. Are you in a network with other investors you have these opportunities? Is that how they materialize? Honestly, it really is just building out your network over time. So I've been in the industry since 2014, which is relatively early, and yet you end up spending a lot of time with a lot of other investors in the space. You say co-investing, I call it putting club deals together. So early on, that was a way for us to upsize our influence within checks that we were writing in the growth equity and venture spaces. Is you could lead rounds like we did with Headset with Poseidon. We've done a lot of work with Wellcan, Poseidon, a number of other firms in the space that we like. I guess in the early days, it's ways to be scrappy. And later on, we've found ways where, like I said, we can sort of upsize our checks through co-investment within our own LP base rather than having to go out to market with other players. We still love doing deals with other private equity funds in the space that we work well with. So that's never something that we write off.
Yeah, it gives you a huge advantage over the individual investor who's just trying to pick winners, because you are also getting approached by your peer saying, hey, we've done some deals together in the past. Here's an opportunity. Do you want in? Where an individual investor doesn't even see those deals.
That's right. And especially from a governance perspective, you find other professional investors in the space that you work well with and you sit on boards together. And that really cements those relationships, which is, I'd like to have Nico or I'd like to have Chi sitting on this board with me because they bring something to the table. They're going to roll up their sleeves. They do the work. And vice versa. We have plenty of other investors we love sitting on boards with because they bring a ton to the table. And to your point, it allows you to not only bring additional capital to the table, but really bring additional expertise to the table. And that's probably the more important part in the end, because a lot of this industry is built on relationships. It's not just who's the best operator, although that's very important.
Yeah. Well, most businesses really boils down to relationships. It's just how it is. Talking about businesses, other investors that we've spoken to have commented that the quality of the companies looking for investment has improved substantially over the last 18 months. Are you seeing that?
Yeah, absolutely. If I roll back to our first fund, there were a number of reasons we did an ancillary only fund. One of them was that there wasn't enough track record in the operating sphere for plant touching businesses where you were confident that you were going to invest in a very strong operator. That was part of it. Part of it was valuations back in 18, like late 18, were pretty wild. A fraction of where they were today on an actual valuation basis, but from a multiple standpoint, we were talking 20 plus current year revenue multiples, which the current year projections were, again, pretty wild. So you've had a lot of time since 2018 in any other industry that's a blink of an eye, and in cannabis, that eons, frankly, to really suss out good operators. And because of that, you gain inertia within the industry. And as you've had better operators come to the forefront and prove that they can not only drive EBITDA through their businesses, because that's less meaningful, it's actually cash flow through the businesses after 280E. Once you've seen that and people have gotten to a point where they can supplement external capital with organic growth, with organic capital coming through the business, I think you've been able to pull in some really strong operators from outside the industry as well. And it's that marriage of talent, which is really creating a new pool of earlier stage companies and mid-stage companies right now are far more grounded, far less pie in the sky than years past.
This is the sound cannabis companies hear when they try to place an ad on Facebook, Twitter, or Google. The tech overlords' arbitrary discrimination against our industry is unfair. But until they change their restraint of trade policies, we need an alternative way to share our message with our customers. Cannabis podcasts are one of the last advertising platforms not controlled by tech monopolies. And for as low as $9.99 a week, cannabis companies have the freedom to play their uncensored commercials to customers around the world. Don't let tech bosses dictate how you run your business. Go to PodConX.com. That's PodConX.com. And for just $9.99 per week, you can go from this to this.
Before I let you go, I want to make sure that we talk about this. It's harder to invest as just a one-off individual investor. The valuations are more reasonable. They're, like you said, they're more grounded. The companies, the management team, everything seems to be more professional and better. What are some advantages for investors to invest with AFI Capital that we haven't talked about? What are some of the other advantages to jump in now? Because this seems like the time you want to be jumping in.
What I would say is we have a different approach for different times in the market, and we've transitioned a little bit our strategy towards Fund 2, which is what we're doing now, which is all, like I said, all private single state operators. And then we have a sidecar where people can lean in with co-investment. I'd say why we think that's the best approach to take right now is we see pretty big inflection points happening in the next anywhere from a couple months to a couple of years, both at the federal level and state level across the country, pretty much. And where we play in sort of private single state operators, and what we're looking at is a pretty massive multiple arbitrage and valuation from where they sit and where your typical public MSO sits. You know, anywhere from 5 to 7 on the current year multiples for public MSOs, for the top tier, you know, bleeding down to 4s, maybe up as high as 10. We're talking anywhere between 1 and 2.5 on private single state operators. So being able to find good deals in that space and viewing this pretty wide arbitrage that's happening between private and public, we see a multiple expansion and growth coming out of these deals is something that's quite likely over the next couple of years. As those top tier MSOs, we expect them to load up their balance sheets once we start approaching legalization again and we have a march towards more federal change. We'd expect them to load up their balance sheets as their valuations start to climb, which we fully expect will happen. It's the easiest path to capital right now in the industry is investing in top tier MSOs. And they're going to have to deploy that capital across the country in order to continue their path to growth. It's not to say they're not still going to have limited license markets that they can tap into where they can win licenses. It's just there's a lot fewer of those opportunities left right now. If we see them coming across the country, they have to dip into markets like Texas. They'll probably have to acquire their way in there. They'll probably eventually have to acquire their way into California. The penetration of MSOs in that market is very light. The valuations are very suppressed at the moment for single state operators that are private. And yet, how can you be a national brand without having good exposure within that market? You can't. You have to go through there. So we really focus on unique assets that we think are well positioned for consolidation with these broader national trends that we're seeing now. And we place our bets there, and then we help those businesses grow out. The next one that I'd talk about after that would be Grassdoor, is our delivery service out of Southern California, which is really a mobile retailer. And the reason we like that so much is it gives great data for any sort of MSO that would want to enter that customer level data. It's an incredible tech platform. So you'd be looking into both acquiring penetration within California and also acquiring a tech asset that you could potentially roll out across the rest of the country. It's those types of assets within the portfolio. It's not quick returns, but we're expecting them to be necessary pieces of the puzzle as MSOs start to work their way across the country.
I'm excited listening to that. It just feels like that's the direction everything's going, and you guys seem like you're going to be positioned perfectly for that. We have the links to AFI Capital in the show notes. So if you're a company looking for some growth capital, or you're an investor that wants to talk to the gang over there about letting them manage your cannabis and investment, I'm sure somebody from Nico's team would be happy to speak with you. Nico, appreciate you being on the show today. This was a lot of fun.
Dan, thank you. I really appreciate it.